Good afternoon, everyone, and a warm welcome to the webinar today entitled How to Retire Early and with More Money. My name is Barry Richards. I'm one of the retirement education specialists here at AVC Wise. Bit about my background is I work directly for this bit at Prudential, specialising in all things AVCs. A few things to cover off before we start. The content of the webinar is provided for educational purposes, it does not constitute financial advice. Information given is based on our current understanding of taxation, legislation, and regulations. Any levels and bases of and release from taxation are subject to change. Tax treatment is based on individual circumstances, it may be subject to change in the future. Fund values can fall as well as rise. Past performance shouldn't be used as a guide to future performance. So more specifically then, this afternoon, we're going to have a look at a case study where I'm going to introduce you to a colleague of yours called Sarah. We're going to look at how retiring early can impact your local government pension. This fantastic, unique opportunity you have available with a local government shared cost AVC. We'll touch upon how a shared cost AVC actually works, and then the reality of how this can help you retire earlier and with more money. And finally, how you actually apply for a shared cost AVC and some further resources and any next steps you may need to take. So let me first of all then introduce you to Sarah. So Sarah's an employee and a member of the local government pension scheme, and her normal pension age is 67, as her normal pension age is linked to her state pension age. And when Sarah gets to age 67, it's estimated that her final salary will be around £29,600. So Sarah wants to know about how a pension is built up, and that's what we're going to have a quick look at here. And Sarah's someone who's been in that pension scheme for quite a long period of time. So she's built up membership in all of the different sections of the scheme. And as some of you might be aware, that local government scheme has changed a number of times over the years. So let's have a look then at what Sarah built up in each section of the scheme. Now, the first section that Sarah built up membership in, what was called the final salary 80th section. This was in operation up until the 31st of March 2008. Now, this section worked on the basis that for every full year of membership, you would build up 1/80th of your final salary as an annual pension amount in retirement. Now, Sarah was a member of this 80th section for just 1 year and therefore built up £397 of annual pension within this section. It's also worth mentioning within this section, you'd also build up an automatic tax-free lump sum, which is 3 times the annual pension. And I'll go into a bit more detail on that in a few moments' time. Now, Sarah's also got 6 years of membership in the final salary 60th section. This ran between the 1st of April 2008 to the 31st of March 2014. And it's still calculated based on what your final salary is, but instead of building up 1/80th of your final salary, you're instead building up 1/60th of your final salary as an annual pension. Now, it's important to note, though, there's no automatic tax-free cash being built up within that 60th section, and Sarah was working full-time over the full 6 years this was in operation, so therefore built up a full 6 years of membership. So 6/60ths of her final salary in this section, which amounted to £3,177 of pension income per year. But the vast majority of Sarah's pension was built up in the career average revalued earnings section, also known as the care section. And this is the section that everyone here today, no matter when you joined, will now be a member of. Now, this section came into place from April 2014, and in this section, for every full year of membership, you're banking 1/49th of your salary within that year as an annual pension income for when you retire. So, for example, if your salary was £49,000 and you were working full time in the care section, you would have banked £1,000 of annual pension income per year in retirement. So Sarah ended up accumulating 18 years in the care section, which amounted to having an annual pension of £11,346. And with all these sections added together, it meant that Sarah's annual pension, with 25 years of local government membership spanning all three sections of the scheme, her total annual local government pension amounts to just over £14,900 a year. And she did also build up that small automatic tax-free lump sum of just over £1,000, as she had just 1 year in that final salary 80th section. So we've just established then that Sarah's entitled to this annual pension amount of £14,920 and a small automatic tax-free lump sum in addition to this. But what Sarah's got to ask herself here is, will this amount of pension income be enough to enable her to do all the things that she wants to do in her retirement? So will she have enough money in retirement to take her family on regular holidays? Will it be enough to make any new purchases, such as an electric car or a laptop that she likes the look of? And that's what Sarah has to consider here. So is that £15,000 or so of annual pension income going to be enough? And remember, those figures we've just looked at assumes that Sarah is going to be working right up to her state pension age of 67. Now, a lot of people we speak to don't want to work right up to that normal pension age. So, in this next slide, we're going to have a look at the impact of Sarah retiring earlier. So, Sarah decided then she didn't want to work until 67 and would like to retire at 64 instead, as she'd like to go a bit earlier to allow her to enjoy the things in life that are important to her, such as spending more time with her family and being able to go on some holidays. Now, you'd think going just 3 years early wouldn't have too much of an impact on Sarah's annual pension of £14,920. So when you think about it, it's only 36 paydays early. Well, in actual fact, by Sarah retiring just 3 years early and accessing that local government pension at 64, it wipes over £4,000 off her annual pension, which is a massive hit for her to take. So why is there then such a big hit to Sarah's pension? Well, first of all, the number of years of membership in the pension scheme is reduced, so she's missing out on 3/49ths of her annual pension by going 3 years early. Secondly, it's because the local government pension scheme will apply an actuarial reduction to her annual pension amount. As the pension fund knows they now need to pay Sarah that pension for 3 years longer than they would have needed to had she retired at 67. So it's that double whammy of Sarah reducing the years of membership in the scheme and the actuarial reduction applied that causes that significant impact to Sarah's pension. I remember it's not just 1 year that Sarah has to deal with this £4,000 reduction. This is going to be every year for the rest of her retirement. So remember, with that annual income as well of just under £11,000, Sarah's not going to be in receipt of her state pension for another 3 years. So that would be her only source of income, £10,843. So just think not only if you could survive on that income, but how comfortably would you enjoy your retirement with that level of income? Some of you here today might be thinking you would like to retire early, but how do you feel about that having such a significant impact on your pension? How important is it for you to be able to retire early? And if it is that important, are you prepared to do some additional saving to make it a reality? So Sarah's got a bit of a problem then, as she wants to retire at 64, but doesn't like the idea of her annual pension income taking such a big hit. So she does some research on the available options that may allow her to take more tax-free cash up front to soften the blow of that lower pension income and help her bridge that income gap of £4,077. Now, whatever pension scheme you belong to now in the UK, you're allowed to take up to 25% of the benefits out as a tax-free lump sum. So when you get to retirement, you've got the option that you could decide to exchange some of your yearly pension income to take more tax-free cash, which on the face of it might sound like a good idea, as everyone likes the idea of money on a tax-free basis. But what would actually happen to your local government pension if you did decide to take tax-free cash from it? So you'd have your annual local government pension at retirement, whatever that amount is in your case, and you could decide to give up £1 of your annual pension income in exchange for £12 of tax-free cash. Again, on the face of it, it might sound like a good deal, but in reality, that would be a whole £1,000 of guaranteed pension income per year that you're losing for every £12,000 of tax-free cash that you take. And also, it's not only guaranteed monthly income that's paid out every year until you die, but crucially, it's index linked. So that £1 that you give up isn't going to stay at £1. It's going to keep going up and up in line with inflation by whatever that CPI is. So if you leave that £1 of annual pension income alone, in all likelihood, you'll be very glad you've made that decision. Now, the only way you could really see commutation to tax-free cash as a good deal is if, unfortunately, you're not going to be around that long in your retirement. Now, one of the main benefits of a local government shared cost AVC is the potential to take it all back as a tax-free cash lump sum without this having any impact on your valuable main scheme pension. And on this next slide, we're going to have a look at some of these key benefits. So when you pay into a shared cost AVC, you're not only going to benefit from tax relief on your contributions, but when you contribute to an AVC on a shared cost basis, you're also making savings on national insurance contributions too. So you're actually getting a double tax break every month as you pay into the scheme. And you've got the potential to take your whole AVC pot all back as tax-free cash when you take it at the same time as your main scheme pension, whatever age that's going to be. And there are always upper limits based on the value of your pension. You've got complete flexibility as you pay into your AVC, in that you can increase, decrease as often as you like, and the minimum amount you can pay in per month is just £2. So let's have a look then at what it would actually cost you from your salary to pay an amount into a shared cost AVC. So we'll have a look at an example here. So if you put a £250 contribution onto your application form, it's only going to cost you £175 and 10 pence from your take-home pay. So there's almost a £75 saving there in tax and national insurance, which is an incredible amount of money to be saving on a monthly basis because of that big double tax break. So again, if we just examine those figures for a moment, the day that you hand over effectively £175, it instantly turns into £250. And every month that you're employed, this is going to keep on happening for you. And then when you access this pot of money at the same time as your main scheme pension, whatever age that's going to be, you could potentially take all of it back at that point as a tax-free lump sum. So it really is a fantastic vehicle to make some really substantial savings towards retirement. So you will get the proactive people that are already doing this, or they get this set up, they then reach their desired retirement age, and they've got this extra pot of money to help offset these big reductions that come by retiring early. And then you'll maybe get the people who put this off or don't get round to taking any action on this. They'll reach that desired retirement age and simply may not have the option or ability to retire earlier. And some people are happy to work right up to their state pension age and get that full local government pension. But you could argue you should still be taking advantage, as if you can get these huge savings every month and then get it all back again tax free. Why wouldn't you want to take advantage of a scheme like that? And for anyone who's currently putting money into a savings account or an ISA, if you have a think on what your current returns on that will look like. Now, I appreciate with the AVC, it is a pension arrangement, so you won't be able to access the money until you're over the minimum retirement age, which is currently 55. But with the AVC, as a basic rate taxpayer, you're getting an initial uplift of 42.77%, purely down to those huge tax and national insurance savings that you get as soon as that contribution goes into your AVC. So again, try and think of any kind of setup where the day you hand over £175 is turning into £250. You're getting that huge yield, and you can get this every single month. So you can imagine how quickly you can build these savings up, even over what can sometimes be short periods of time. And by the way, for anyone in the audience this afternoon who is a higher rate taxpayer being hit with 40% tax, and that proportion of your salary at 40% tax will get that higher rate of tax relief. So for you, that uplift is over 70%. So let's look at a worked example here. So here we've got Joe, who's earning £30,000 a year. So he's a 20% basic rate taxpayer, currently not paying into any AVC arrangement at all. And his gross pay before deductions amounts to £2,500 per month. Now, Joe pays tax on his eligible earnings amounting to £258 and national insurance of 10% amounting to £145.20. So when you look at it, Joe's not far behind in paying as much national insurance as he is tax. Now, once these deductions are made, it leaves Joe with £1,934.30 take home pay. So that's the money going into his bank account each month. But Joe's decided to plan for his future and save some extra money for when he retires, as we generally don't save enough money through our working lives to prepare for retirement. So he makes the clever decision to start making contributions into a shared cost local government AVC, the arrangement that everyone here today can contribute into. So let's see then what happens to Joe's payslip when he decides to start paying a monthly £250 contribution into a shared cost AVC. Now, the first thing you see is Joe's gross monthly pay has gone down to £2,251. That's because the AVC contribution he's making is on a salary sacrifice basis. You might be thinking, if Joe's salary has gone down, won't that have consequences when it comes to calculating his benefits on his valuable main scheme pension? And the answer to that is absolutely not. So your local government pension fund will use your notional salary, which is the salary before any salary sacrifice is made when it comes to calculating your main scheme benefits. So therefore, there'll be no impact to Joe's main scheme pension. And as you can see, his main scheme contribution remains exactly the same. You can also see he pays a token £1 personal contribution, and his employer makes a £249 contribution. This is just how the AVC works when it's operating on a shared cost basis. So your employer contribution is the amount that you're sacrificing from your salary, and there'll always be a token contribution of £1, which is classed as a personal contribution. So that full contribution amount, in this case £250, is sent across by Joe's employer to be invested with his provider. Now, as Joe's now paying into an AVC, the money he contributes into it means he no longer has to pay tax on this money. And as a result, Joe gets 20% tax relief on his AVC contributions. It means his tax comes down from £258 a month to £208 a month, saving Joe £50 every month. If you also have a look at what's happening to his national insurance contribution, you can see he's now only paying £120.30 national insurance a month, which is around £25 less than what he was paying. So he's now getting that double tax break on his AVC contributions, as he's saving on the national insurance as well as on the tax. Now, in basic terms, then, for Joe to pay £250 into his AVC, it only reduces his take-home pay by £175.10, purely down to those big tax and national insurance savings he gets. So that double tax break on the national insurance contributions as well as income tax is what makes this such a fantastic vehicle to make some potentially really substantial savings towards retirement. So before we go any further, then let's have a closer look at how a shared cost AVC actually works. So you pay into your AVC directly from your salary, and that money goes into your AVC pot, which is an extra pot of money that sits alongside your main local government pension. As mentioned, you can really flexible, you can increase, decrease those contributions as often as you need to. Minimum contribution being just £2 per month. The money you put into your AVC is then invested, and your pension fund has already chosen the company responsible for investing your AVC contributions. For the majority of you, it will be the Prudential or Standard Life. It could be clerical, medical, or legal and general. Now, the good thing for you is you've got complete control over how the company invests your money. You can take as much or as little risk as you want. I'll show you shortly how you can access this information. It's also worth noting any investment returns are free of tax too. You've then got the flexibility to choose how you take your AVC benefits in retirement. So you could decide to convert your AVC into a variety of pension products. But remember, being in the local government pension scheme, you've got this unique option whereby you could take your AVC pot of money all back as a tax free lump sum. So let's revisit Sarah for a moment and see what she did when she got to retirement. So Sarah then reaches the age of 64 and she accepts that her benefits are going to be lower because she's going to have fewer years in the scheme and lower still due to the actuarial reduction. So what Sarah did is she contributes into an AVC in that really tax efficient way we know about, getting that double tax break. And then she takes her whole AVC back again as a tax-free lump sum at the point of retirement. And she uses that tax-free lump sum from her AVC to help bridge the gap between retiring early and then getting a state pension at 67. So ultimately, at age 64, Sarah now has this tax free lump sum to do the things she wants to do, whether that's going on holidays, replacing the car, or just spending more time with her family. She's now got control. Now, that last example looked at Sarah taking a whole AVC as a tax free lump sum at the same time as her main scheme pension. But what if Sarah does want to retire 3 years early at age 64, but just live off that AVC pot of money and not access a local government pension until the age of 67, and therefore avoid any actuarial reduction? So essentially, just finish work and live off her AVC until she's then ready to access a main local government and state pension. Now, in this next example, we've made an assumption here that Sarah managed to build up a fairly sizable pot of money in her AVC, amounting to £48,000. And the reason we've used this assumption will become clear in a moment. Now, when Sarah wants to access this AVC pot of money separately or earlier than her main local government pension, she then has to unlink those two pots by transferring her AVC out. So she decides to transfer a shared cost AVC over to a personal pension. Now, by separating those pots, she's now lost the ability to get all of her AVC back as a tax-free lump sum. So Sarah gets to age 64, she leaves her main local government pension where it is, and she defers taking it until the age of 67 to avoid the actuarial reduction. And she's transferred her AVC over to a personal pension. Now, this is where she gets clever, though, about how she accesses the money and where it's a bit clearer as to why she saved £48,000 into her AVC. Now, essentially, what she does is she withdraws £16,000 in the first year of leaving work at age 64. Now, when she takes a £16,000 withdrawal from her personal pension, 25% of it is tax free. So £4,000 in Sarah's case is tax free. Now, you can earn a certain amount of money each year before you start paying tax. It's called the personal allowance, and this tax year it's typically £12,570 the UK government allow you to earn before you're due to start paying any tax. So once Sarah's taken £4,000 of her £16,000 withdrawal tax free, it leaves her with £12,000 of that withdrawal that she may have to pay tax on. But in Sarah's case, she's not in receipt of any other forms of income, and so that £12,000 can also be taken tax free retrospectively. Now, Sarah does this exact same thing for each of the 3 years at age 64, 65, and 66, where she takes a £16,000 each year, with £4,000 tax free automatically, and the other £12,000 falling under the personal allowance. So she can retrospectively claim the tax back she pays on that as well. So her AVC pot has allowed her to retire 3 years early at age 64 by bridging that gap between leaving work and then accessing a main local government and state pension, taking the whole pot tax free. So essentially, the bigger your AVC pot, the earlier you can retire and bridge that gap. Now, in Sarah's case, her main scheme pension at age 67 then gave her an annual income of £12,905, which is quite a bit more than that £10,843 she would have been in receipt of if she'd got the actuarial reduction by taking a local government pension earlier at age 64. And for anyone wondering as to why Sarah's local government pension isn't that £14,920 that she would have got if she retired at 67, it's because although she has avoided any actuarial reduction, she does still have 3 less 49ths in the pension scheme due to retiring 3 years early. Now, with both of those examples we've looked at, essentially, the more you save into your AVC, the more options you have for retirement in terms of retiring earlier and with more money. Initially, the most important thing can be to get the ball rolling, start getting those huge tax savings, and give yourself these options for further down the line. So, a few key points to summarise. The local government pension scheme is the only public sector scheme that allows the AVC to be taken as a tax free lump sum. Employers have to choose to set the AVC on a shared cost basis, and this is what your employer has done for you, which is great news for you because it means your contributions are going to benefit from both the tax and the national insurance savings, with that potential then to get it all back at the end as a tax free lump sum when you retire along with your main scheme pension. So, can you think of a more efficient way of saving towards retirement? Where else are you going to get that double tax break like the shared cost AVC offers, and potentially then be able to take that whole sum back again tax free at the point of retirement? A few conditions and considerations. Now, you have to be an active member of the local government pension scheme to pay into shared cost AVCs. And remember, you don't damage your main scheme pension when you pay into a shared cost AVC. You can't pay in an amount that will take you below the national minimum living wage requirements. And don't worry, this will always be checked when you submit your application by your payrolls there. Neither can you go below the lower earnings limit, which is £6,396. And there's the general government restrictions on what they allow you to pay into pensions to consider. So you've got what's called the standard annual allowance. This is the amount the government allow you to pay into pensions within a tax year and receive tax relief on. And that figure is £60,000 per tax year. And your main local government contributions will count towards that figure as well. Now, this could be impacted if you've previously drawn on a pension, as you can trigger what's called the money purchase annual allowance. Now, this is only relevant if you flexibly accessed a private pension. So if you've got an old pension from the police or local government, this won't be relevant. It's only if you flexibly accessed a private pension. And you'll always be sent a letter informing you if this was the case. There was something called the lifetime allowance, which was abolished. What's been kept in relation to that is a maximum amount of tax-free cash that anybody is allowed, and that figure is £268,275. You can change your AVC amount when you log into your account, and adjusting that amount will then have an impact on what your AVC pot value will be in the future. And opting out or leaving employment would simply mean your AVCs would stop. They would sit there and remain invested until the point you access them. Just means you could no longer add to them. So for anybody here this afternoon who hasn't yet got your AVC up and running, it's a very straightforward process. You head to our website, log into your account, and on the home page, you just click on the new application button. You then just pop in your details and select the fund or funds that you want to invest in. Now, within that application, you've got the opportunity where you can download the fund guide. This will give you details about all your available fund choices. You can read through this and then come to a decision as to where you'd like to invest your AVC contributions. Now, you might see in that guide that your employer has already chosen a default fund for you. And you'll see on the application form, the box asking you to select your fund choice will already be filled in for you with your default fund if you have one. And you can change that fund choice at any point as well. So if you did initially set this up with a default fund or whatever fund you like the look of, remember you're not locked into those details. You can change your mind on this at any point. The important thing can often be to get this up and running while it's fresh and start getting those savings. Once you submit your application, it goes straight to your payroll for them to do their checks on, and would start from your next available pay run. And then your AVC would be established with your provider. As mentioned, for the majority of you, that would be the Prudential or Standard Life. They'll post you out a welcome pack confirming all your details, and they'll send you statements going forward showing you what you've put in there and how it's all doing. If you're somebody already paying into a shared cost AVC and you need to change the amount, very straightforward. You just log into your account, click on Manage My Shared Cost AVC, and simply enter that new amount you wish to pay going forward. Now, sometimes people do need a bit of an extra hand when it comes to setting up an AVC. So you have got the opportunity of booking a one-to-one meeting with us, and that might be with myself or one of my colleagues here at AVC Wise. These meetings last up to 20 minutes, take place on Microsoft Teams, and we can give you a helping hand there to set up your shared cost AVC. We can look at things like calculating the maximum amount you can build up in your AVC and get it all as a tax-free lump sum. We can look at your most tax efficient contribution you could make and really just make sure you're making the most of this unique opportunity you have available to you. In advance of those meetings, we'd ask if you could get a local government projection to your desired retirement age, an up to date valuation of your AVC pot, and also an up to date payslip. As you can see at the bottom of that slide, we're not providing any financial advice or investment advice at the meeting, but we can give you factual information and a bit of guidance to help you get your AVC up and running if you need to do so. So if you need to get in touch with us here at AVC Wise or book in a one-to-one, you can email us at support@avcwise.co.uk. We also have a live chat facility on our website. Or if you prefer the more traditional method, you can always just pick up the phone and give us a call there. Please check out our Knowledge Hub. That's got some really useful information on there. It's got some videos that have all the key information about AVCs into bite-sized chunks. And there's also a really useful calculator tool there where you can play around with any figures you were thinking of paying in or increasing, and it'll highlight to you just what you're going to be saving through those tax savings and just how big you can build up that AVC pot potentially too. You will see there is an FAQ document that is bespoke to your employer, and that's got every question we've been asked about the AVC from A to Z put into a handy document there for you. And if you're looking for more details about your main local government scheme, you can find these on the lgpsmember.org website. So, the key message this afternoon is although that local government pension scheme is no doubt a fantastic arrangement to be in, you do need to ask yourself, is it going to be enough to achieve the goals that you have for retirement? So is working to state pension age something that you're happy to do? If you would like to retire earlier, are you going to have enough money to bridge the gap and mitigate the costly actuarial reductions that can be applied on your pension? Shared Cost AVC allows you to save additional money for retirement in this really tax efficient way. And then you've got this unique opportunity that's only available to local government members where you can potentially then take that whole pot of money you've built up all back again as a tax free lump sum. So we've had a look at a couple of examples and figures today. I'd say whatever it is you can afford to do, make sure you are doing something to take advantage of those huge savings. Have a quick look on that calculator on the Knowledge Hub. And I hope this has helped to highlight what a great opportunity you have here. And you do go on to reach those goals. Now you've seen just how achievable it can be. So finally, many thanks again for your attendance, everyone, and have a great remainder of the day. Thanks a lot. Bye now.